Hi, I'm Brett Willoughby, CPA. Today we want to talk about the 2015 tax law changes that affect overseas Americans. Let me give you a little background first. Congress has a problem, overseas Americans have a problem. Congress has a problem because they're giving away more money, they're spending more than they're taking in, and they want to give away more tax benefits. So they have to increase revenue somewhere. The second problem that Congress has is that 25% of all refundable credits, historically, are fraudulent. So a refundable credit is things like the earned income credit, the additional child tax credit. What happens is a refundable credit is you can get a refund from the federal government even though you did not pay anything in and you pay no income tax. So obviously these are target-rich environments for people who want to fraudulently file a tax return and receive cash back. Overseas Americans have a problem in that they don't have good representation in Congress. There's no natural constituency. If all the overseas Americans were in one state, it'd be approximately the size of New Jersey. That's 8.7 million Americans living and working outside the U.S. who don't work for the military or the State Department. These types of laws would not go through if they were represented by one particular congressman or delegation. So the U.S. has a worldwide tax system, and overseas Americans are taxed on all their earnings, and what the changes do is basically they start pulling back some of those tax benefits. So let's start with the American Opportunity Credit. The American Opportunity Credit is also a refundable credit. It allows you to receive up to $1,000 per child who's attending college, and it's cash in your pocket. The schools that are eligible are any FAFSA schools. As long as that college has a FAFSA number, you're eligible. So there are virtually all colleges in America have a FAFSA number, and many colleges outside of America also have a FAFSA. FAFSA is a U.S. financial aid package. So if you have a child going to an international FAFSA school, you need to receive a 1098-T starting in 2016. A 1098-T, or a worksheet that shows how much was paid in tuition and the school's employer identification number. The problem is these schools, or international FAFSA schools, are not U.S. entities, so Congress cannot compel them to issue 1098-Ts, which are typically the tuition worksheet statements. So what we're advising our clients this year is to talk to your school and see if they will issue a tuition worksheet statement for next year that will have the amount of tuition, scholarship, and the employer identification number next year. If they don't, you will no longer be able to qualify for the American Opportunity Credit. The second change that affects overseas Americans is that you will no longer be able to amend tax returns for the additional child tax credit if that child or student did not have a TIN or a Social Security number by the October 15th, the extended due date of the tax return. So what typically happens overseas is someone can have a baby overseas, or they can adopt a child, and it will take a long time to get that Social Security number or ITIN number. And if that child does not have a Social Security number or ITIN number by the extended due date, typically October 15th, in the past we would go back and file the return without the child, and once we got the Social Security number, we would amend the return. Going forward, starting with tax year 2015, you will no longer be able to amend tax returns for additional child tax credit for the 8812 if they did not have the Social Security number by the October 15th due date. The third tax change, and this is the most significant one, is that Congress said that a taxpayer cannot claim both the additional child tax credit and the foreign earned income exclusion. So that will cause some problems. What we think is going to happen is that you'll find more overseas Americans taking the foreign tax credit, more overseas Americans married filing separately. So husband and wife will file two different tax returns. And what we're going to do is when we prepare the tax returns for our clients, we're going to evaluate what makes the most sense for them. Just to kind of give you an example of what this is, or what it looks like, many overseas Americans, one person will be the primary earner, will make less than $100,000. This taxpayer will take the foreign earned income exclusion. The other spouse will make between $10,000 and $30,000, not take the foreign earned income exclusion, but they would qualify for up to $1,000 per kid additional child tax credit. What this law means is that Now, we will no longer be able to do married filing joint. We will do married filing separate. We'll actually file 2 tax returns, one for the husband and one for the wife. In this case, the wife would file her tax return not taking the exclusion, and she would take both kids to get the additional child tax credit, and the husband would file his tax return taking the foreign earned income exclusion. This is something we're going to evaluate with each of our clients this year as we process your tax return. So let us do what we do best so that you can do what you do best. Thank you very much.